Welcome back. Thank you for your patience. Right, I want to continue on. So where we are now, let's just consolidate, because I feel like I have been talking a lot and it might feel that there is very little method in the madness. Where I hope we are at now, either in the room or for those of you who have been listening on these recordings, is that we've got a general sense of what M&A transactions are for, to an extent at least what, in broad terms, lawyers do in M&A transactions, and the kinds of commercial issues that M&A lawyers need to be aware of but are rarely involved in advising on. I guess, as a headline, the dirty little secret is that M&A is not actually a legal discipline in itself. What we are really doing is drawing on your contract law skills. It's likely to draw on your personal skills when you are doing it too, and skills that you draw out of things like negotiation, but also corporate law, so company law. Now, company law too, in company law, for those of you who have done it already, you've spent a lot of time doing a range of different things. Ryan, you should scoot around a bit. I'm sure you can't see there, and it's like... you're not going to block my view overly, and I doubt you'll block anybody else's. So, please join in. So, sorry about that. God, I'm really not on it today. I'm so sorry. So, you will be drawing on negotiation. Corporate law. So, company law is clearly statutory interpretation is a big part of that, but understanding the nature of the company. So I know I've been sort of, let's face it, dicking around a little bit here, playing with my toys and moving post-it notes and money around, but I think there is real value as an M&A lawyer, as a corporate lawyer, in actually understanding where those differences are and who it is that we are advising and who it is that has rights and has obligations. So now that we've got past sort of thinking about really, really early stage companies, really early stage businesses, our imaginary case study business that we're going to work with here has got at least to the stage where it is, it's incorporated, it might have some friends, family, full that are involved in it, but it needs to go to the next level. When I'm talking about that we're thinking about it strategically knows that it needs to raise some money in order to make some money, and that ultimately the company is the vehicle that it's going to use to take risk with other gentlemen's money. So companies raise money for a whole heap of different reasons. So a startup company will raise money to grow, to fulfill the vision of the founder, to take it in the steps between, the garage to the IPO. Money is usually needed along the way to make money. One of the most successful and, I believe, profitable companies in the world at the moment would be Amazon. And Amazon listed well before it had made any profit. It was relying on shareholder funds to that point. So that literally means that investors, initially individuals, subsequently professional and sophisticated investors, were giving them money to grow their business until it got to the point where they actually made those shares publicly available for trading. One of the most anticipated and discussed IPOs in the last 4 or 5 years would have been the Facebook IPO. I think, in fact, I might add it to your reading, I think Mark Zuckerberg's letter to shareholders in his prospectus should be compulsory reading for investors everywhere, because the rules clearly in the US are different from here. But the reason that Facebook had to IPO is the rules in the US effectively meant that they could not issue any more shares to private investors who had joined the company or to their employees unless they became a listed company. And so we don't have exactly the same rules here, although they often work the same way. And he effectively says in his letter, I don't want to list. I don't want to share information with you publicly. I am always going to control the vote, and I'm going to do things the way I want to do them. I'm actually amazed that more wasn't made of that when he was brought in front of the Senate committee in the last couple of 18 months or so, because it has actually been, he has done exactly what the legislation in Australia anyway would have asked, which is disclose what your intentions are. What is management going to do? And he has been very clear that actually he intends to control it and make the decisions. So other founders will do that for a very different reason. Many others will go to listing on the basis that I've built this business to this stage, I'm now going to let it fly, and my intention is to sell as many shares as I can. I was involved in the computer share float. So float is the word that we often use instead of IPO. We talk about IPO as the transaction, but the company floats. And when you think about it, that's what the language is. It's like floating currency, similar sort of idea. What we do is we fix a price that we'll sell you shares, but once it's actually trading on a stock exchange, the price of the shares is no longer in the board's control. The market determines what people are prepared to buy for and what people are prepared to sell for. So the company floats. The price goes up and down regardless of what's actually happening in the company. So with a computer share float, that was another fintech in a sense. Computer Share runs a share registry business, and it operates all over the world. It's one of the largest. ASX has considerable investment in it, and it's quite a large company now. It was a very successful and very profitable company at the time it listed, and it had 3 or 4 founders from memory. They were all in their late 40s. They were certainly too young to retire, but young enough to have a good time if they had money. And basically when they went to market, they raised some money, a very small amount of money to fund some projects overseas, but mostly when they went to an IPO, they were selling shares. So they were shares that had been owned by founders that they were then put into the market. People bought those shares. The original shareholders took away cash, went on and had great lives, some of them in the business, some of them doing other things, and then otherwise they and the company continued on. But to get from garage to IPO, there are usually a number of, and the language we use is rounds, capital rounds that happen along the way. So why do investors invest in startup companies? At the very early stage, more often than it possibly should be, they want to help a mate out or a family member out, which often leads to tensions. Most investors, their intention is to make money for themselves. At the early stage, it's high risk, high reward. So their expectation is that by getting in early, if the company is successful, they will make a significant multiple on the money that they invest. So we often hear this language of PE, price to earnings ratio. So that is the amount that you pay versus the amount that the company is making. Often the PE is extraordinarily high at early stage because there are no earnings, right? So you are paying a huge multiple of earnings. You are effectively betting on the future of the firm. By the time a company lists or at later stage development, they are usually have some kind of earning. And so another way of valuing the business is effectively how long would it take just from the profits of this company for me to get my money back. So that the market changes from time to time, but if that price earnings is, say, 10, if I'm going to invest $1 now and it's going to take 10 years before I get my dollar back in profit or in dividends, then that suggests that I think that this is a pretty strong company that's pretty stable and it's likely to grow in capital terms. If the PE is 1, as in I'm going to pay you $1 now, but I'm expecting to get that dollar back today, that suggests that I've got a very short-term view of what that company is likely to be. And so usually at the early stage we can't use a PE, but we're expecting a long-term return on our investment. Secondly, early stage investors, particularly those who are in the business of early stage investments, understand this idea of a portfolio. That sure, it might mean that that 20 or 19 out of 20 investments they never get anything, but they would expect more than 20 times the return on at least one of their portfolio. High risk, high reward. So your risk is quite high that it will fail, but if it succeeds, you expect a significant multiple on your return. Doesn't always happen, but sometimes it does. So often that's why early stage investors will look at having a portfolio. So they might pick a particular industry or area that they're interested in where they think, I think there is going to be a lot happening in the robot industry over the next 10 years, or I think we need to invest in cryptocurrencies. So people who've invested in cryptocurrencies, many of them will have looked at having a portfolio of different cryptocurrencies. Others might look at non-speculative uses for the blockchain. The blockchain, many investors I speak to still say blockchain is a solution in search of a problem. I'm going to look at all of these different ways that blockchain is being applied. I agree with that approach. I'm going to find as many different ways as possible and put a little bit into many investments on the basis that surely one of them is going to come off. So they're looking at making money. Often the thing that is really important for investors at an early stage to understand is it can actually be quite hard to exit or to realise your investment. So if I buy a share in a company on the stock exchange today, whether that share increases or decreases in value, it's not that hard to sell it. So even if I'm a pretty novice investor, pretty much within hours, I can sell a share. And I can see my money within 2 days. But if you invest in an early stage company, or for that matter in a family business or a local business, finding a buyer and the time period in which you can actually realise your investment can be very, very slow. So at the early stage with businesses, and I was talking before about when you're a startup founder might be looking to sell some of their shares, but clearly, often investors are like, if somebody's prepared to invest in this company, we want the money to go into the company. So it can be very difficult to actually realise the investment. Of course, everybody's out there looking for the unicorn. So the unicorn is that, the startup that rapidly achieves the $1 billion valuation. Companies like Airbnb, Uber have been described as unicorns. So there is a bit of a punting mentality. I've had some big wins and some big losses on the stock exchange over time. I don't ever bet big. But again, I think I've never bet on a horse in my life. I cannot actually walk through time zone, much less where there are those gaming machines. Like, gambling is just clearly not my thing, but for whatever reason, taking a little punt on things on this stock exchange from time to time, I find that fun. I find it something that's interesting to do. But again, I would never invest money that I wasn't prepared to lose. In fact, wasn't expecting to lose is the way it sort of ends up, sadly. My husband, unfortunately, gets excited every now and then when he sees things go up. Also very bad at selling. Anyway, this is not a how to invest in the stock market course. That would never be taught by me.
Trading.
Sorry?
Day trading.
Day traders, yes, exactly. Day trader one year, insurance broker the next. We don't have any insurance brokers in the room, do we? Very unkind. And then there are also investors will look at startup companies for strategic reasons. So I mentioned Accenture. What are they called? Reinventure yesterday. Reinventure is a fund that has been seeded by Westpac, which invests for strategic reasons in companies that are setting out to disrupt the banking industry. So again, this slide comes from a law firm website, or the image does, and it maps out what is really a pretty common way of working through fundraising for small companies. This sort of language, it very much comes from the way that it was done in the US, and we've adopted a lot of the ideas and the way that US small cap fundraising has happened, particularly over the last 5 years. The reasons for that are really around consistency, and also because the size and of the market for investment in small cap companies in Australia is significantly smaller than the US. And there have been a number of places, not just in the US, where investors have kind of congregated, and that we've seen the growth again over the last 5 to 10 years of things like venture funds and accelerators and incubators, where investors have brought small, particularly tech companies in, co-located them to share ideas, mentored them, done more with the money that they've brought in, more than in the investment than just the money that they've brought in. They've brought in training, resources, connections, etc. And so there have been a number of companies from Australia that have gone overseas for that investment. The Netherlands actually has a really thriving startup tech community that with quite a significant investment regime there, and interestingly, a lot of the startup tech stuff that was happening in the UK has moved to the Netherlands since this on-again, off-again Brexit thing that has been going on. Norway also has a thriving tech startup and investment community. Hong Kong and Singapore as well, but clearly the ones that we're probably most aware of would be Silicon Valley, San Francisco. There's quite a growing group in Chicago and in Houston now, and New York, but Silicon Valley and San Francisco is probably what's best known. Vancouver goes up and down over time as well. So basically this is a pretty common pattern, starting out with the friends and family and the fools, and then going through to a seeding round. So a seed round is really just the first sort of toe in the water with professional investors. Sorry, I'm just trying to move my screen here so I can see something. Here we go. Cool. So it's usually only 1, 2, sometimes it's called an angel funding range. So it's somebody often who has some connection or some other business reason for wanting to invest in a startup. Often they will join the board, not always, but really it's a usually quite informal sort of round of fundraising. Now, ideally, each round of fundraising, the number of shares that you issue will be less and the amount of money that you put into the company will be more. That's what companies want. Doesn't always happen, But companies that are on the right sort of trajectory will find that. Any of you fans of that show, The Shark Tank? You see it occasionally. Often they have quite robust conversations, and one of the reasons that the sharks will be out is that too much has been given away already. They will talk about it's just diluted. So, yeah, I like your business. I would put in the $500,000 that you say you need, but I'd be looking for at least 50% of that, and you don't have that available. And I want you to have at least 30% remaining because I need you to feel involved and continue to be involved in the business. And so offering or issuing too much early on, I'm done with my thing. Offering or issuing too much early on can actually inhibit your ability to do rounds down the track. So again, this kind of strategy isn't the stuff that lawyers need to do, but we need to be aware that these are the kinds of things that the commercial advisors and the company will be thinking about as we build the documentation that supports this, because there is documentation that's going to be needed. Ideally, at this stage, we would be entering into some kind of shareholders agreement. So a shareholders agreement, something that protects this investor and our founders as well. So I'm often will refer to these guys as the founders. So there's got to be a neater way for me to write than this. So by thinking here at this stage about what the shareholders' issues are, it's one thing to protect this person, and that might be working through things like issuing preference shares that mean that they get their cash back if it's wound up before these founder people do. It might also set out the kinds of things that management, because they're often the same people, can do without involving our new investor. But a shareholders at this level also needs to anticipate what's going to happen with potential future rounds. So what kind of issues do you think you might need to think about for a shareholders agreement at this early stage? What kind of things would you be thinking about if you were investing in a startup company? Let's do it from the point of view of our investor first. What kind of protections would you like to see or expect to see, given what we know about your ability as a shareholder? So a liquidation preference. So if things go bad, I want to get my money back before the others do. Absolutely. So let me just call that liquidation preference. What else?
The founder maintaining a minimum shareholder.
Okay, founder maintaining. Certainly, we would call that locking the founder in. What you're really... So I'm just going to go back. Are you going to the hardware store because you want to buy a drill or because you want to hang a picture on the wall? So I want to talk about, well, what's the picture on the wall here? What you want to do is make sure that the founder remains involved in some way. And so one of the ways of doing that would be to make sure that if the company is successful, that they've got enough, that they're going to be successful. So that's a mechanism for doing that. The actual act in a shareholders agreement of maintaining somebody's percentage is quite a difficult thing to do, because the very nature of creating a fixed proportion of a pie, so if we're going to say, okay, this is a square pie, this company, and we're going to say the founder always has to have 25%, if it turns out we need to grow this pie, now what we could do is we could add new capital in. We've just made this company into a bigger pie, but then somehow I've got to be able to lift this shareholders' percentage so it's roughly 25% of what's gone. So if I'm a new investor coming in here and this guy's going to get more money, how's that going to work down the track, especially if he's not paying for it? Great. It's actually a great suggestion. Don't get me wrong here. It's a fabulous suggestion. What I'm trying to do is point out the complexity, and it's exactly the kinds of things that we need to think about. So it might be that what we're thinking about here is really early on, do we need to create some kind of pull or incentive? Do we need to promise that there is an employee or an operating something to incentivize our CEO or our key people? Do we need a carrot and stick? Interestingly, this early stage, one of the things I see often is in the shareholders agreement is an obligation and an agreement that the company will enter into a insurance policy on the life of the key individuals, life and term illness, things like that. So that if our CEO has a nervous breakdown, falls under a bus, etc., that the company gets some money that it can use to pay somebody else to do that work. Okay, it's again, the availability of those policies will, and the cost of those policies can impact the ability to do that, but it's a common way of addressing that sort of problem, because you can't. I think it was Michael who said yesterday, when somebody says, we want to make sure we lock in these key employees, it's like, well, good luck with that. Contracts of personal employment or personal service are not specifically enforceable. So even though the shareholders agreement is likely to include something where a shareholder promises to be locked in, the actual individual is hard to do. One of the things that it might do, though, is it might actually provide a stick as opposed to a carrot. It might say, okay, you founders, you've got your shares there, but if this nominated person who is attached to you as a founder, so Cathryn Nolan as a founder of Domicom, the investment entity was the Nolan Joyce Family Trust. The trustees of the Nolan Joyce Family Trust might make a promise that if Cathryn Nolan ceases to be an employee of the company, that it will sell a percentage of its shares to the remaining shareholders at a particular price, or at a price that will be negotiated. So there'll be a good leaver and a bad leaver provision, for example. That might be done in a shareholders agreement. It might be done in an employment contract. Again, it's about asking the right questions, and you're absolutely asking the right questions here. What we need to do is think about what is it that the investor's looking to protect. Then we can think about, well, what tools are available to us to do that, and then we think about how might they affect things down the track.
You'd want triggers in there about how much they can spend seeking investor approval.
So again, remember, as shareholders, we have absolutely no ability to enter into contracts for the benefit of the company or to commit the company to doing anything. But the company now is holding our hard-earned money. And whilst we might be portfolio investors that expect some to fail and some to lose, we're not actually just putting our money on black, closing our eyes and hoping for the best. We're saying, actually, we're putting our money into this company in exchange for the promise you're going to spend it the way you said you would spend it. So shareholders agreements often set out, it's usually as simple as a budget, and there will be a requirement. It could a promise that the company will report to the shareholders. So company is usually a party to the shareholders agreement, every month, every quarter, whatever it is, of how they are tracking to the budget. And that if there is any expense or anything that they want to do, that the CEO wants to do, that is outside of the budget, usually plus or minus 10%, that they are required to go to the shareholders to get approval. And then that leads out to other things that basically shareholders will reserve certain types of interests or questions to, the company the shareholders agreement will reserve certain types of questions to meetings of the shareholders, things that would normally be dealt with by the board. So the company and its shareholders will agree that if you want to go and issue more shares, you need to get the approval of the shareholders. And it might state whether it's a majority, a special majority of some sort. It might actually stipulate that all of the new shareholders get, all of them need to agree, or a majority of the new shareholders agree, or that every shareholder who holds more than 25% needs to agree. So you can actually skew the way that you vote. So given that it's small at this stage, why wouldn't the shareholders just put themselves on the board and make sure that they, why bother with this agreement, do you think? Why wouldn't you want to be on the board? You may not want the director's duties associated with it. Absolutely. So does that mean that incoming directors who basically, whether they have a strong shareholders agreement that lets them effectively make decisions, or whether they just come in every couple of weeks and tell everybody what to do, does that mean that they, if they're not on the board, will not have obligations as directors? Company law refresher for those of you who haven't done it. The answer is it depends. And what does it depend on? Largely how good ASIC's argument is in court, and whether they get found out perhaps before that. So if you actually look at the definition of a director is effectively a person who ordinarily controls decisions that a company makes. I'm not quoting directly. The definition hasn't changed much and has been considered in the courts a number of times. There is no requirement that you are on the register to be a director. There is an offence if you are a director and you are not on the ASIC register as a director. But there is no requirement that there is a board resolution appointing you as a director. If at the end of the day you can go in and tell people what to do and they do it, then chances are you are a director. So again, people want to avoid that because they want to avoid the liability that is associated with that. But again, as lawyers, we need to be aware that the shareholders agreement is not necessarily going to be the thing that just gets our clients out of that obligation. By the way, I'm sure in this pack there will be, or in one of them there will be a discussion about shareholders agreement, and I'll probably go over it. I just don't like PowerPoint.
The other thing with the anti-dilution.
So just actually, before we get to anti-dilution, because I think that is important, the kinds of things that are often reserved here to shareholders are things like not just the budget, but what it is that the company is going to do. So if the company's in the robot business and it appears from doing that business you'd make what entrepreneurs would call a strategic pivot, that actually rather than us sell our robots, we could, the two that we can make a month, we could sell white label the software driver that we have created to move the robot's eyes from left to right and back again. We could put that in robots all over the world. We've got this absolute opportunity that's changing us from a hardware business to a software business. It'd be quite common for shareholders' agreements to require the shareholders to agree to a fundamental change in the business. We know from the way the company law works, if you want to change the name of the company, that you need to have the approval of at least 75%, so a special resolution of shareholders. You might actually lift that even higher. Founders sometimes want that, particularly if a company, it's their company, it's their baby, and it's got their name attached to it. They will often want a very high for a change of name. So there can be a little bit of ego in that. But other things around the management too. So the appointment of a CFO, a law firm, an accounting firm, an auditor. The auditor's appointment does get approved by shareholders at the high level, but that is not something that would normally be reserved for shareholders. They're often reserved for shareholders in shareholders agreement. Again, the question is not what mechanism do you need, the question is what problem do you want to solve. Sometimes the more locked down the founders and the operating team are early, the harder it is for them to continue. Anti-dilution is often a big part of the battle here, because clearly one of the things that the founders will want to do is continue to increase this pie by offering other series of investment going forward. So sorry, I'm just going to move this away so we're not quite so messy as I talk about it. So often we use this lettering like Series A, the first round of shares that are offered to external, so completely external investors. This will often be a syndicate, there will often be a broker used. Again, there are economies of scale in a sense in having very similar terms in Series A, Series B, Series C. Again, because the investors do it a lot. And so there can be benefits to companies who are seeking investment from professional investors, investors who know what they're doing, who are not going to panic immediately there's a competitor comes out of the woodwork or something changes. And one of the ways to do that is it's much easier if I hold 20 investments, if the terms and conditions on which I hold those investments are pretty similar across them all. I don't have to go and get separate legal advice every time something goes wrong. So if we have a pretty similar way of managing the company, pretty similar ways of what it is that I can, as a shareholder, can say yes or no to, pretty similar rights in relation to how much I have to own before I get a seat on the board and whether I have to exercise that or whether I can nominate somebody else to do that for me. Pretty similar issues in relation to confidentiality, for example. Having very similar regimes makes it much more cost effective, because at the end of the day, it's the company that's raising the money who ultimately pays that fee. So if I'm putting $1 million into a company, I'm likely asking, or a broker will be asking for a placement fee. And that fee will likely cover things like the investor's legal costs. So often that comes out at that early stage. Questions, concerns, frustrations? Any of you investing in small caps or early stage? Couple? Anything you want to add? Anything consistent, inconsistent?
No, pretty much. But I invest in markets.
So you're investing through the market.
Yeah.
So actually, Matthew mentioned before, and I didn't think to say about it. There are a couple of platforms. There's a small cap market in particular where companies can go and actually register and invest. I was going to pull it up, but I didn't get enough time in the break to do it, to have a look. Well, you can go and look at these things. And again, when you have a platform, one of the benefits of a platform is that the rules are the same for all of the players. So you are comparing like with like in relation to the rules, not necessarily in relation to the investments, but in relation to the rules. So again, the regime very much sits on this idea of disclosure. And so you have the ability to have a look at what it is that's being offered, what rights you have as a shareholder in different ways. So what does an investment really look like? So early stage tends to be equity investment, some kind of ordinary share or a convertible preference share. So preference shares are given in, I always talked about this, give a right in preference to ordinary shareholders, usually on a winding up. Sometimes they also have preferential voting rights as well. Or they might have rights, preferential rights in relation to a particular issue. So one of the early series that Domicom had included preference shares. They had equal voting rights, they had preferential rights on winding up, but preferential additional voting rights in relation to an exit event. So if there was an opportunity for the company to be sold to a third party, so the business to be sold, they had preference shareholders basically they had 2 votes for every 1 ordinary shareholders vote on that issue. And that came about because some early investors were, in my view quite rightly, concerned that the founder was really hell-bent on listing and couldn't see any other exit or any other strategy. And some of them did not believe that a listing would be the best strategy. The market might actually have proved them right. And that as a consequence, if they had an opportunity to sell the technology into a bank, they were betting with their money and they were buying with their money an extra vote. How did they get that? That was negotiated with the company, and it went ultimately to price. They would invest more money if they got that additional right. So actually the rights that attach to shares are effectively contractual rights as well when you think about them. And the share is the evidence of ownership, and the constitution of the company is technically the contract between its members and the company itself. But it doesn't have to be the entire agreement. So again, another reason for bringing a shareholders agreement in is that the idea is that that will be removed at a later stage when shareholders are on a more equal footing. We spoke yesterday about convertible notes. I don't really intend to go any more detail there, but a convertible note is actually lending money to the company with the right to convert it to equity later. How do they actually do that? And I guess the thing that this slide should include now for proprietary limited company is the CFS or CSF, the crowdfunding regime that we were just talking about earlier. And in the break, actually, so Matthew was mentioning to me in his capacity as a business broker that Michael, I keep calling you Matthew, so I've got Matthews in the brain today. Michael, so it's Equitas is the platform that you were talking about? Yeah. Equitize, so which is using the crowdfunding regime for proprietary limited company. I haven't looked at it yet, but there's been a big boom on it in the 12 months since those numbers that I had in the previous slide pack were there. So it might be worth looking at it. Like, I'm just interested in what's happening. And my quick ring around to mates, I'm not hearing anything about it. Again, that's how disruption happens, isn't it? People who are doing something, they're not in the same market. They're not competing with the people who have been doing it the old way for a new thing, so they're not being noticed. So it's put me on notice to go and have a better look at what's going on. So what kind of documentation do early stage investors expect to see? They will expect to see a document which is almost always called an information memorandum. It is effectively a business plan. It is a kind of disclosure document. It is similar to, but is differentiating itself by its name, and usually in the disclaimers you would include inside it from a prospectus or a regulated disclosure document. They will often want to look at the business when we use the word business plan in that context, they will often be wanting to look at the actual financial business plan, at the Excel spreadsheet, at the actual numbers. This will be supported by a high-level pitch deck. Pitch decks seem to vary in length and what they cover. A couple of years ago, I was seeing pitch decks that were sort of 50 slides in lengths quite regularly. I'm working with a small startup at the moment, and we were talking to somebody the other day about introducing them to some relevant angels, and he was saying, look, I need a modified pitch deck, maybe 3 or 4 slides max. Like, everybody wants things to be shorter, and we've got more and more obligations. I'm not quite sure how we make this work.
If you go online, you can actually obtain the earliest pitch decks for some of the biggest companies in the world.
So I was going to suggest that if you look at Startup Vic in particular, the Startup Vic website, actually SlideShare has them as well, but one of the great things about the Startup Vic website is they have some the CC, the Creative Commons licensed sort of model pitch decks. And again, it's almost like this early stage fundraising is being commoditized. But again, when you're presenting as a company seeking investment, information in the way that the people who are thinking about making an investment can make sense of it, that they can compare it with the other opportunities they have, and they can really easily sort of put the numbers you've given them into their own financial model, you're just making it easier for them to consider your investment seriously. Often, they will also be looking for some really early stage technical due diligence. Often that'll just take the form of sending their guy, a guy that they trust. Again, almost universally a man, but I might be belabouring that point as well, who'll go in, often a financial person, but might also be somebody who has industry specialty. And to just go in, sort of expressions we tend to use are kick the tires a little bit. Not necessarily ask for anything particularly confidential, but just get a sense of how people work together, who they've really talked to, how much sense does that founder make. A lot of emphasis in the industry goes to the importance of founders being able to pitch, to be able to present well to investors, and to be able to present well to potential customers. I don't think any real research has been done on how the follow through from that. I would be really interested in that. I see a lot of very introverted, very clever software developers who I think have absolutely fabulous ideas, but one of the big strangleholds to them actually raising that early stage is just their lack of skills when it comes to presenting in public. And it would be really interesting to find a way to actually study whether or not that's about getting the money as opposed to having the good ideas. I'd really like to start my own fund that only spoke to introverts who didn't want to pitch. I think that would be a way to get away from the masses. So, lawyers sometimes, probably close to most of the time, 50-50, might get involved at this early term sheet stage. It is not uncommon for early stage investors, particularly the founders, particularly ones who are confident, to go online and find a term sheet and just put that in front of people, or for the investors to come with their own term sheet. So they'll have a standard. Again, why do investors want to do that? They're making many investments. It makes sense for them to start with the model that already works for them. They tend to learn over time what is palatable and what is not. But she who drafts wins. And so often coming to the table with a nice term sheet that looks good, that reflects a conversation that a founder has had. I have had founders tell me when they've been locked into something a couple of generations earlier, oh yeah, the investors told me it had been looked at by their lawyer, it should be fine. Of course, it's been looked at by the investor's lawyer, not by the founder's lawyer, and it is fine for the investor. But so often term sheets will start at that early stage. The idea of a term sheet is getting the major deal points agreed before we go to the legal documents. Often they have bullet points. Getting lawyers involved at that stage can substantially increase the cost, which is one of the reasons why, particularly if you're not 100% sure you're going to get the money coming in, founders are very wary about doing it. I have seen some maturity in the venture capital ecosystem over the last 5 or so years, where we're seeing much more consistency and fairness in the documentation. It would be very unlikely that anybody could argue that a VC's term sheet would fall within the unfair contracts regime, because even though a venture capitalist might start with the same standard form each time, they are notionally negotiable documents, I think it would be very hard, quite easy for somebody, if that argument was raised, to disprove it. Although there is often an inequity of bargaining power, because you've got a venture capitalist who's got money, got legal advisors, may even have in-house counsel working with them, and founders who are often desperate for money and ill-advised or not advised at all. Some of the content of some of these slides, by the way, come from a presentation that was given by a lawyer from DLA Piper this time, when we were at this stage last time around, who unfortunately wasn't available for today's session either. This summer I've had really bad luck with just availability from my key speakers. I'm hoping that I have 2 next time. I've only got 1 confirmed, so we'll see how we go. But he uses this language similar to English. So we're all aiming for plain language, but often they're inconsistent, they're negotiated over email. You kind of need to know what they are. Recent contract lawyers amongst you will remember Masters and Cathryn and the importance of trying to work out, well, what the status of a preliminary agreement is. Is a preliminary agreement that has been signed, is it actually an agreement? Is it a promise to sign a formal agreement that doesn't deviate from those terms, or is it simply a preliminary agreement that's not binding? Sorry, I'm sorry about the coughing, but I need to hear you to repeat for the recording.
I was going to say, when we do a hits of agreement, one of the things we're very careful about is we can draft it as a non-point, but we have the solicitor review it, because it does have some binding elements in it, even if it's mostly non-binding. But one of the things it will commonly say is the parties explicitly agree that this does not obligate either party to enter into a later contract. To get around that.
So Masters and Cathryn is effectively a solution for solving a problem, right? We have a decision, it provides the 3 categories. There's the Borkham Hill Hospital case that suggests that there's potentially a 4th category, but I am not clever enough to distinguish it from the 3rd category, and I've never actually really seen a decision that suggests that. So it's a problem. So ideally, those of us who are lovers as opposed to fighters want to avoid having the problem or the uncertainty in the first place. So a well-written term sheet will be very clear. It will say, these things are binding. We're going to keep the information confidential. If we ultimately lead to an agreement, the price will be within range A to B, or whatever it is that's important to the deal. And these things are not binding, or nothing else is binding, unless often it'll have a little carve out that says unless you need that term to interpret a binding term, it's not binding. So sometimes we end up with anally retentive lawyers who insist that the definitions will be binding, or these definitions will be binding. It all gets out of hand sometimes. In the market, though, it is very rare, once you have a signed term sheet for a deal, not to go ahead at this early stage funding stage. That this is where the commercial agreement happens. Where it doesn't go ahead is usually if there is a dramatic change in the circumstances. So the market itself, the business, due diligence uncovers some potential issue, like, you don't own the IP, you've got a huge tax problem, you've committed a fraud, you're sending data to Russia and rigging elections, whatever that particular big issue is. When you've actually got to the stage of a term sheet, it is actually commercially very, very rare for them to fall apart. Again, those of you who are in the market, would you agree with that? Generally? You can disagree with me.
No, look, on average, I'll go through, let's say, probably 8.
Buying and selling a business, I would say 80 or 90%.
Yeah.
With investing in an early stage, I would say we're talking 99.9%. So, and again, as a consequence, the ecosystem seems to have changed to build in some more mutuality and fairness because it is a high risk, high reward enterprise, and the investors recognise that too much constraint can actually mean that it's just easier for founders to walk away than it is for them to work with their money. What else?
Cal has some standard, the Australian Investment Council.
Yeah.
They've got some standard resources where you can actually just get a pro forma term sheet.
Yeah. So, and I'm seeing the AVCAL resources being used more and more. In fact, to the stage where when AVCAL, so what I end up having to do is always just do a comparison against what I've got against just the AVCAL standard, because it makes it just quicker to give advice on and what it is. So the other thing, the university doesn't have a subscription to AVCAL, but which is probably more commonly used than what you would see in the Encyclopedia of Forms and Precedents. But you can have a look in there and you'll see that there are early stage capital raising documents there too, and they're not terribly different. The kinds of things that term sheets will deal with will include evaluation, what it is that's actually been offered, what the pricing will be, what the capital, I'll show you some capital structure tables in a minute. And basically a venture capitalist is looking at balancing the risk and the reward. Usually at this very early stage, they are aware that it's likely that there's going to be future rounds. So thinking about what the impact is on dilution is quite important to them. So one of the things term sheets will often include is a right to participate, maybe a first right to refuse. So if the company's doing well but needs to raise more money, then the investors will want the right to take up that offering first before new people. So that often will be dealt with there as well. I think this is a ridiculously hard to read comic once it got expanded, but I think it's not even a particularly funny one, but I think it's worth noting that it's kind of talking about this. So the conversation goes, the VC's basically bragging to his mate that, he's got really, really good terms, and, they've got 50% of the company, 100% warrant coverage, 4-time liquidation premium. The founders are such suckers. Then of course things have gone badly, and they're out of cash and they're basically just disappearing, and the VC's basically left with nothing. So there's risk for VCs in tying up founders too much as well. So I want to talk about the deal terms that are key to the kinds of early stage capital raising that we see all the time. And so basically, in a nutshell, I want to look at the economics, which the flashing light should indicate I'm going to do first, control provisions, value protection, and liquidity. So what kind of control, or economic provisions should I say, do we look at? Clearly, we need to think about what the valuation of the enterprise is, and that's often doing rough and ready pre- and post-money calculation. So pre-money valuation is often really hard to determine with early startup, but we're effectively, we either work backwards from calculating what it is that somebody's prepared to put in for what proportion of the company, or sometimes we can identify a pre-money valuation based on an offer that's been made by somebody to buy the business. So what's usually most relevant to investors is what's the post-money valuation going to be. So if I've got my little robot enterprise here and I'm 100% owner, and I'm looking for $1 million from you angel investors, and 10 of you get together, 10 of you agree it's a good idea, and you'll put in $100,000 each. Now I can do that under the 2 million rule. So it's less than 20 of you, less than $2 million. You're doing it all in the same time. Means in the next 12 months I can only raise another $1 million under that exemption from up to another 10 new people, but I'm happy with that. My post-money valuation of the company would be $2 million. It's got $1 million worth of cash plus the assets that were already in there. Some of that money might immediately go to paying costs. Say I'm paying, I've seen some exorbitant rates at the moment, paying the person who went to see each of you angels a 10% capital raising fee. I'm already down to $900,000 in the bank plus my assets straight away. So the post-money valuation, or the amount that was actually paid, saw us with a pre-money valuation of $1 million, and the money came in at another $1 million. Everybody's got shares that are worth, let's say, $1 each, but I've already spent $100,000 of that on capital raising. Might spend another $30,000 on other costs associated with compliance and legal fees, accounting fees, getting other things sorted out. So I'm already down a little bit. I might have had some outstanding bills. So say I've got $800,000 in the bank to spend on the project at that point in time. So let's think roughly that means, I'm doing the maths in my head, if we were selling our shares today for what the company is worth exactly, we would probably get 90 cents each for them. So we've already gone backwards on day one. It's quite normal. So again, that might play out by negotiation. We might be saying, well, actually on that kind of number, if you've got $1 million there, given what all of the transaction costs are going to be, etc., we're going to be looking for 1.2 shares for every dollar we invest. So you're already diluting. So again, contractual ways, negotiation ways of solving the problem. So valuation, a lot of things go into valuation. A lot of it is just negotiation, especially at the early stage, because you cannot know what the company is worth. The other things, we often call them wild cards. Some lawyers tend to talk about them as being the card tricks, is the extent to which there is an option pool. So options, you'll remember, are effectively a promise to issue a share at a particular price in the future. So that can change the valuation remarkably. So if I have an option that allows me to buy a share in the company for $1, and that company share is currently worth 70 cents, everybody's just discounting that. But in the future, when the company has grown and its shares might be worth $2, my ability to buy something that's worth $2 for $1 can substantially change the valuation. So again, we've got to look at those kind of things. Again, lawyers are never asked to do the maths, and when they do the maths, they often do it badly, but we need to understand what we're actually thinking about here. The amounts, often we need to think too about in the economics. If each of you were investing $100,000 into my company for your 1.2 shares for every dollar that you spend, it's a very different proposition if the company has $900,000 worth of cash in the bank at the end of the transaction than it is if it only has $300,000 cash in the bank. So it is quite usual to include economic terms that require a minimum subscription amount. Again, that usually comes out of negotiation. At an early stage, it's often 100%. If I'm looking for $1 million, then the offer will only close if I get subscriptions for all of the $1 million. If I don't get, or if I only get 800,000, then effectively I don't get anything, because each of you would be promising me your $100,000 on the condition that the whole of the $1 million that I need to execute the business plan that I've promised is followed. Does that make sense? Okay, so warrants, again, kind of an American expression here. I've seen them used particularly in the fintech space. Reinventure uses them quite a lot. So they're often creating an extra kind of security that will bridge the gap between valuation and the money that the company needs. So like a convertible security, they tend to be strategic. They tend to carry a risk premium with them. So again, a kind of convertible note, but usually giving the company or the board, the shareholder group as a whole is the way that it plays out, the ability to call on additional funds in particular strategic circumstances, or to turn loans into equity. American investors particularly like that because they don't want to really take risk, particularly on companies that are a long way away. So they might want something that looks like a loan that gives them the power to turn it into something else later on. We've spoken a bit about convertible preference shares earlier on. Sometimes we have preference shares that a convertible note will incorporate a dividend or a coupon. So we don't really like to call it a dividend because otherwise it'll be taxed as a dividend, as income. But so it's usually, we'll have the name, the coupon on it. And that's basically the interest on the loan. But if it actually becomes, if it's converted into an ordinary share, then that coupon will be a dividend and will be taxed accordingly. And the deduction won't be available to the company for the interest that it's paying, which can be very important when companies are early stage and they don't actually have income. And then we have anti-dilution provisions. We've basically been talking about those. So they often take the form of rights to buy, to participate when the company is offering more shares, the rights to call if somebody else has the opportunity to sell their shares, the rights to tag along and to sell your shares at the same time. When the company is issuing shares, a right to a first refusal. And sometimes even if the company is looking at spinning out or selling its business or part of it, the right to an involvement in that share or business sale itself. Oh, sorry, I had some terms there. I should probably have gone there. Hopefully that will help you as you go through how some of those work. Let me just keep going. I'm taking too long. Kinds of things that you'll think about as you're negotiating or you're writing out these kind of provisions will include what happens on liquidation in particular. These are all kind of economic or basically return on investment type of provisions. Again, good place for you to have a look at these and to think about these will be the Encyclopedia of Forms and Precedents in particular. I am seeing much more of American language coming into these documents. Any of you who've actually read an American drafted legal agreement will find them very difficult to read. They're a very different style of writing from modern plain language English or Australian drafting. Lots of passive language. They also don't space things out. They're very thick paragraphs, can be quite difficult to read, but we're seeing more of their kind of language, like the warrant language, for example, different kinds of participating, non-participating shares, etc. And again, the reasons for adopting that language are to make these investments attractive as well to overseas investors. One of the things that's often really important at this stage is there's more way than one way to end up with an exit. And so listing a company will provide a market on which people can sell their shares once they've invested. But often we need to think about if the sale of the company as a whole to a third party or the sale of the underlying business, if that is a potential exit as well. And so as we look at liquidation preferences and what the different rights are attaching to shares, we need to think about how, again, are we buying the drill or are we putting the picture on the wall? What we're really trying to protect usually for investors here is that if the company can realize value in some way, that we get a return on our investment. So whether that is the company we've invested in selling the assets that it has amassed and its business, its subsidiaries getting cash, how do we make sure that that cash comes back to us as opposed to the directors just finding something else to invest it in and us having no control? Or how do we make sure if there is an opportunity to buy the company as a whole that we can make those founding shareholders tag along, that we can make sure if Google wants to buy our robot business, we want to sell our shares, how do we make sure that the others tag along with that? They're all the sorts of things that actually you need to think about at that really early stage. I said I'd show you a kind of cap table. I have no memory of where I pulled this from. I think I pulled it because it is a very American looking one and it kind of makes sense. So we do tend to have this idea of, well, what does the cap look like pre-money and then post-money? So pre-money is before this new investment comes in. So the new investment is effectively the new shares that are coming into the company at this stage. Yeah, so we've got some, where is it going? We've got 8 million pre-money shares. They're probably outstanding common stock. Very American language again. They're likely to be the ordinary shares, but this is the language, even when we're dealing with Australian companies, the language you will see on a term sheet will refer to the common stock, even though they're ordinary shares, right?
In the US, can't they hold shares that aren't issued on the company share register as well?
Yeah. So you can have, and in some places you can even have bearer shares, but I don't actually want to complicate us here. So you can see the holders of this common stock before money, let's just get rid of that one, held 80% of the company. The founders had 80% of the company. When these new shareholders come in, they're going to be diluted, is the language we would use, to 50%. So still the same number of shares. The pie got bigger though because we have issued these preferred shares. So these are probably preference shares. There were none on issue before money. We've now got 4 million of them that are going to represent 25%. That 8% went down to 5%. This 12%, we've issued more here as well. That's gone up to 20%. So these are reserved options. So basically a pool of options. One of the ways that I can see from this table that these incoming investors, people who are buying these shares, are also getting some options which will help them have the right to put more money into the company later on at a particular price. And we can see pre-money valuation 8 million, 11.2. Just based, this is before anything's happened with the money, right? It is highly likely that this number, particularly given how neatly this ends out, that this is an agreed valuation, that 80% and that 8, where the parties have actually agreed that the pre-money valuation is this, so we're going to put that in here to end up with that. Making sense? Okay, often you will see a cap table look like this too. This is basically showing what the impact will be of the minimum investment as opposed to the maximum amount that's being sought. Okay, so you can see looking at this that we've got different numbers of investments and what will happen to these shares if the predictions come true.
Explain again 25% post money.
So the 25% post money.
Yeah.
Okay, so what's happened here is there was nothing here. So before they purchased, before any investment was made, there were no outstanding preferred stock on issue. So somebody has paid 80 cents a share by the looks of things for 4 million preferred stock shares. That's new money into the business, and it represents 25% of the shares on issue. Beforehand, so this number's gone down and that number's gone down. This one has also gone up because they bought some of them too, by the looks of things.
So basically the biggest losers were the outstanding common stockholders.
Biggest losers in terms of dilution. Yeah, so we could say, well, and often this is an issue because when you think about it, so if we think about this company as a box that has assets in it, at this stage, this box was this big. And these guys owned 80% of it. Okay? So they owned 80, it's probably closer to there. They owned 80% of this box here at this stage. These new people have come along and they've added something in there. They've brought it from, this was $8 million size box. They've upgraded to the 11.2 million size box. This is still roughly 50% of the size of the box, right?
Yeah.
They still own exactly what they owned before. The box has got bigger. We don't know what they paid for it.
Paid $2 for those shares.
They might have paid $2, they might have paid nothing. And it actually doesn't matter. The price of the share means nothing. What has happened is at this particular time, they paid
80 cents because the pre-money is $8 million market cap and post-money is...
okay, sorry, that 80 cents is in here. So we know they've paid 80 cents. Sorry, I'm not doing the maths in my head. So you can tell he's an investor and I'm just a lolly advisor. But from thinking about it proportionally, because the dollars actually, they matter to the investors, don't get me wrong, they absolutely matter to the investors, and we actually have to think about the way that we behave in a discussion about this when we're dealing with the investors and we're dealing with the founders as a consequence. But from a technical point of view, we had a piece of pie that was that big. We made it this big. Some of it might have been eaten in the past, but we've added to our pie. Somebody who had 80% of the pie now has 50% of a bigger pie. And this new money has come in. So all of these, the people who are here, they've not lost what they had. We've just made the pie bigger. Now, on the particular day that we made it bigger, that's what those numbers were. If 2 weeks before we had done the similar transaction, it might have been that this number was 20 million and actually these numbers would have been completely different as a consequence and this little bit of capital would have only been there. It really just depends on the market and what the values are. But as lawyers, I think sometimes we shy away from the numbers too much. And it is not our job to do the valuation or to think about that by any stretch of the imagination. But one of the things I've consistently seen through my career is lawyers who cannot actually visualise the pie getting bigger and smaller. I'm seeing you nodding your head. You've seen that too.
If you don't even understand what the numbers are, you're not going to be able to point out a potential error of it.
Yeah.
Because you might just say, something looks a bit strange here. Can you go back and retrieve it?
Yeah. Absolutely. And look, and I'm a great believer of visualising it, and I'm a great believer in asking a question.
So as a lawyer, you need to know a little bit accounting.
I don't think well, yes, you I think you do need to know a little bit of accounting, but I don't think you need to know more than the common business person would need to know. But I do think you need to understand where the money moves. And you do need to understand what these proportions and what the differences mean.
In Melbourne, they offer a subject, accounting for lawyers.
Yeah, they do, which unfortunately we don't issue, and that we don't offer. But they have a range of, a bigger school, they have a lot of things. One of the best things that
CFA.
Yeah.
Chartered Financial Analyst.
it's just hire one.
No, do that. So there are 4 levels. It's like CA or CPA.
Yep.
CFA is just different. So,
The old the Securities Institute court is what I did back in the day. But I mean, actually, financial literacy, frankly, it's important for everybody, right? But if you're going to be a commercial lawyer, you need to have basic financial literacy. One of the things that actually I'm planning to show you this afternoon is a tool that I use a lot. Got a couple of MBAs in the room, haven't we? Called the Business Model Canvas, which I think is one of the easiest ways for lawyers to get a balance sheet onto one page and to understand what it does. And no, this is not an accounting course, right? I am not an accountant. I am not a financial advisor. My advice to you is you need to be good lawyers, right? But the way to be a good lawyer is by asking the right questions and understanding what it is that you're trying to do here. Are we hanging a picture on the wall, or are we just going out and buying the drill? And one of the things that can happen, particularly lawyers under pressure, to get things done quickly, you have databases of precedent documents, standard documents that have been used over and over again, and it is efficient. That is the way that you need to put your documents together. You'll be working in a commercial law firm, you will be given a precedent, you will be asked to modify it for the deal that you have been told about. Unless you have a basic understanding of what it is your client is trying to achieve and what the numbers mean. It doesn't mean you have to calculate them, but what the different elements of the transaction mean, that is not something, you are not going to know for sure that you've picked everything that you should. And it does take time. And, I think one of the problems the profession is needing to address at the moment is, lawyers like me, I sat in the same office as a senior partner for 18 months of my early career, doing due diligence, listening to his phone calls, learning the craft of being a lawyer. A lot of the things that I was hired to do, we don't hire people to do them anymore, right? We can mark up a document by just doing that in Word. That's easy. So one of the tricks for the profession is, how do we go from people who are coming straight out of law school to people who actually are going to run deals and who get that kind of industry expertise? And a lot of that, I think, is going to be back onto you guys to look for continual education, for understanding, identifying where the gaps are and what it is that you need to know, whether that is about the numbers, or whether it's about the industry that you're working on. So, should I stop giving sermons? Let's look at some of the ways that we deal with control. I'm going to race through here because I think we've talked about a lot of these things already. But really, even at the very early stage, contemplating future investments, it is quite common to be dealing with preferred rights. We've already seen that. Another mechanism for looking at control is to think about board composition, board representation. Often at the really early stage, investors will think, that's too risky for me. Sometimes too, the reason that you want an early stage investor is because of their strategic relationship with you. They might be a customer or a supplier, so you might not actually want to share all of your information with them, the level that you might if they were a board member too. So often that is a bit of a discussion at this early stage as well. So these are the kind of protective provisions that we were talking about when we were talking about shareholder agreements earlier on. Control 2. What percentage of shares do you think you need to have in order to control a company? 51? 40%. So let's have 51. At 51%, what can you do and you can't do? 51%, you've got a majority decision, right? You can pretty much vote off board members. So you can veto them. Over time, you can probably get enough. Can you change the name of the company and what it does? Just without? No, you can't.
Declare a dividend.
You could declare a dividend if you've got a control of the board. Once you've got control of the board, you can do quite a lot of things. But from a shareholder's perspective, so you've immediately gone down from 41%. So some people might say they need 75% or 76%. 76% you can pretty much do everything, right? As long as you're not committing a fraud on your shareholders, you can pass a special resolution, you're absolutely right. At 51%, you can't do everything, but you can pretty much control the board. If it's antagonistic, it might take you a bit of time to get there, but you can pretty much control the board. At 40%?
Not quite, but you do at that point have a fair amount of control and decisions as a member of the company.
At 40%, you absolutely do. It would be, at 40%, it's pretty hard, unless the other person has 60%. If you have a group that controls 40%, it's pretty hard for anybody else to do anything because you can pretty much veto everything. If you have a very diversified share portfolio, company register, so you have got lots and lots of small investors and you hold 25%, there's an argument you can control at 25%. In fact, and we'll get back to this when we look at the takeover provisions, corporations law effectively says there's an argument you've got control at 20%. So there is a general prohibition for public companies that are continuously reporting entities, so that is all listed companies, plus companies that have enough shareholders that mean that they have to report anyway, that once you have 20% or more of the company's shares, but less than 90%, that there is a prohibition against you acquiring any more shares without issuing a takeover bid, unless, surprise, surprise, an exemption applies. So the most common exemption, we'll go through all of them in some detail soon, but the most common one is often called the creep provisions. So the creep provisions allow you to buy small amounts on market, provided that you don't exceed, oh God, I'm having an ancient day today. It's not even an old timer's day. But my memory is it's 3% in 6 months. Rolling 6-month period. And then you have annual times when the company has to report who is on its share register, but you also have to report movements in shareholding for anybody who has more than 5% if their shareholding increases or decreases by more than 1% of all of the issued capital. So again, so the law contemplates that even with as little as 6% of the shares, or 5.001% of the shares, that it is relevant for other investors to know if you're buying or selling shares because of the potential for that to impact their understanding of how the company is controlled. But when we're talking tiny little startup, first seed investor companies, control is usually really who's at the helm, who can sign the check is really probably the most plain language definition of control that we can have. And ultimately that is exercised through board positions, through shareholder agreements, through the terminology and the way that a shareholders agreement is worded. Whether or not we have independent directors, it's quite rare at the very early stage to include independent directors, largely because they're expensive. It's usually hard to and expensive to obtain directors and officers insurance policies at the very early stage. And usually any director who's appointed will also be a shareholder, either as a founder or as an early stage investor, as a strategic investor, or they'll be an employee of the company, which means that they're not what we would generally classify as independent. So control in this sense, I guess the point I want to make is control in this sense is usually the human beings who are the board members.
But any regulation like someone hold a 75% share, and then they can change the regulation of the company.
So at a 75% share, if somebody has amassed 75% share, the reality is, because of the way the takeovers rules, and I will defer the longer answer to this to when we get to the takeovers topic, is that won't have happened overnight, right? It will have happened either under a takeover bid or as a consequence of a scheme of arrangement or as a consequence of some other transaction that shareholders have approved. At 75%, yes, the constitution could be changed, a range of special provisions could happen. There are a number of rules that are in place to prevent a fraud in the minority if and when that happens. But I'm talking about in a public company scenario. Under the takeovers provision, once you actually get to 90%, then the compulsory acquisition and compulsory divestment provisions will take place, because by 90% the legislature basically says, well, at 90%, if you got less than 10% of the company, or if you are one of many 10% or less, then you can't do anything. You have no control, and the company is effectively held by a 90% shareholder who is in one group. So there are two sides to the coin. That 90% shareholder, it will be clearly a lot easier and cheaper for them if they're not listed and they don't have to continuously disclose to shareholders, and they can consolidate as a tax group and blah, blah, blah. So they have rights to compulsorily acquire the shares that that are still out in the world. And similarly, shareholders who end up caught up in that final 10% have a mechanism where they can compel, is the word I'll use, compel the company to buy back their shares, or the successful bidder in a takeover bid to acquire their shares.
There is also Virgin Australia at the moment on the ASX that has about 3 shareholders comprising about 90% shares. So it's not the same, but it's still a potential.
Absolutely, and if they end up as related parties, then we have a significant issue. We might use that as a case study next time we come together to look at how that works. In a private company scenario, again, it's not going to happen overnight, right? That somebody has 75%, but you would normally have a shareholders agreement. Please, I can't direct the morning tea at the same time. Open, eat.
I realise I need some sugar fan.
Yes, sorry. I have taken your advice. I'm powering through. If anybody, I'm barely able to talk without coughing. Eat, talk, and cough. It's going to be terrible, right? I'm just trying to see. I think we have spoken about all of these different, maybe not all of them, but these are the kinds of things that we think about putting these basic protective provisions in place. They might be in the term sheet, ultimately to go into a shareholders agreement. They might be in the documentation itself. And yeah, again, these are a list of others that are often in, these actually come, I think, from the Reinventure standard pack. So again, this is a word that some of you might not be familiar with, vesting, that comes up quite regularly. It comes up in terms of shares vesting and options vesting. Anybody want to hazard a guess at what a share or option vesting means?
They're locked up until that time, they're not allowed to deal with those shares.
Ultimately, so the words locked up were used here. Ultimately, it means that A share or an option vesting means that the owner of that share or option can now realise value from it in some way. It doesn't mean that the share doesn't exist, although it might be capable of being cancelled. It just means that it can't be sold, it can't be dealt with by that person until it has vested, until it has become whole. Options vesting, the option exists. So an option here, I'm talking about a company making a promise to the holder of an option that they will issue a share at a particular price at a particular time. It might be a straight price. This company has options available that will allow option holders to pay 20 cents to buy a share, regardless of what the share price is, or it might be a calculated price. You have a right to buy a share at 80% of the volume weighted average share price over a period of time. Again, this is just straight old-fashioned contract law. So an option itself is just a contract between, in this case it ends up with a bearer contract really, but it's a contract between the company and the person to whom it issued, that it will issue the share to that person or to any person that the person they received the option in the first place transferred it to, or that subsequent person transferred it to at that particular price. And consideration needs to be paid for that option. So a person who holds an option usually pays for it, usually a very, very small fee, but not always. Sometimes they're particularly in employee schemes, it might be that the employee pays, say there's a transaction like this one going on, the employee might pay, shares might be being transferred for $100 at this stage. The share price is actually quite low at this stage. The employee might pay 50 cents instead of $1 for a share. So they're basic, and the promise is that if they pay the other 50 cents, they can get a share. So they've effectively paid half of the price anyway for the option. In the future, they will be taxed on the difference, but they've got this capital base that they've paid for that particular share. It's not an uncommon way for doing it, particularly when the expectation is that they will actually exercise the rights. Oh, sorry. I am really sorry. Other control terms, controls over employee ownership, we've spoken a little bit about that. That does tend to be a bit of a carrot and a stick. You get these shares if you stay, you lose these shares if you go. Sometimes too, because syndicated investors, so groups of investors will come into an investment at the same time, and so there might be rules within that particular group. So if there are changes, so if all of you 10 people who invested in my robot company a little while ago, if you might be doing that as a group, and you might agree also amongst yourselves that if one of you wants to get out, the others have the right to buy that person's shares first before the company does have any such right. Key deal terms, usually from the investor's point of view, also go to protecting the value in the investment that they have. So that's often around preemptive rights and about their ability to convert the interest that they have into something else. So if they have, for example, a preference share, it's likely to include terms that mean that on an exit, whether that's an IPO, sale of the business, that they can convert that to an ordinary share and participate in the IPO just like every other investor. Preemptive rights are basically if the company is going out and raising more money, or the company has opportunities to do things, or other shareholders have opportunities to do things, their rights to either require that the other shareholders can't sell their shares unless they get an offer for your shares as well, or a right to prevent them from selling unless similar amounts go into the company, those kind of things. Now, liquidity really is the question of going to whether or not you can actually sell your shares at all. They tend to be dealt with in the ABC rights. I rarely see significant matters going to liquidity really early on, but companies that are really thinking about moving forward to go through a number of rounds and then go to an IPO will often have terms in their shareholders agreements or in the terms under which the initial subscriptions that address things like the ways in which shares can be redeemed. So in other words, converted back to cash, and the extent to which dealings on the share register can be addressed. So this can be very similar to preemptive rights, but preemptive rights tend to deal with the company as a whole, where when you're looking at registration or liquidity rights, what we're really looking at is the extent to which the company is controlling the ability of shareholders to get in and out. And as you get more and more shareholders, sometimes the price or the value of a security can be affected by an investor who just actually for other reasons, nothing to do with their interest or faith in your business, just needs to liquidate the assets that they have to meet a call somewhere else, to pay a mortgage, to get a kid out of jail, whatever it happens to be. And those things can have a flow-on effect into your own company. So there are a range of different terms that can be put into these arrangements to address those. Now, again, I'm not expecting you to be able to draft those terms or to recognise them, not even necessarily to understand what each of them are, but what I am wanting you to do is to think about the reason that we're buying the drill, to be able to go back and think about, well, what kind of things would you be thinking about? So one of the tasks actually goes to putting together a checklist for the kinds of things that you would put into an agreement and why. And I'll tell you now, I'm much more interested in the why than I am in the names of clauses. I'm interested in the problem that you would be seeking to solve. So, getting towards the end at last. So from a lawyer's perspective, we usually come in at or after the time that the term sheet is signed. So a lot of these kind of rules have been addressed way before, or these solutions have been addressed way before we get involved. And it's at that stage, once the term sheet's signed, even though when I'm talking about really early stage capital, it is very, very unusual for a deal to actually not go ahead in the long run. I think what you find is that we still need to, for investors, do due diligence and then translate into a long form. So one of the only reasons that I've ever seen really early stage deals, once we've got a signed term sheet fall away, is because something has come up in the due diligence that has fundamentally changed the value of the deal. And to be fair, actually, it's involved dishonesty each time, that there's been a misrepresentation of what the deal was. So due diligence at this sort of formal due diligence is really it's largely at this early stage a box-ticking exercise. It's around confirming that there aren't skeletons in the closet, that there hasn't been a misrepresentation. And this usually involves both finance and usually involves legal as well. And depending on the industry, it might involve an industry specialist, although often you'll get an industry specialist coming in at this early stage before they sign if the investors don't have understanding of the industry itself. What kind of long form agreements? That is really terrible small print to read. I'm sorry about that. Particularly if we're talking a very early stage, there might be a wholesale revision to the constitution of the company. One of the ways that this can be affected is that the investors will say, yeah, we'll give you the money this stage, one of the conditions is to you being able to access the money is we need you to replace your existing replaceable rules or your existing constitution with this constitution that they've presented. So that means at the closing, which we'll get to down the track here, before money changes hands and shares are issued, the existing board members will have a meeting, an existing shareholder, if there is any, well, there will be at least one of them, will basically sign the resolutions and submit all of the forms that they need to create this new constitution here. There'll usually be a subscription agreement. So the subscription agreement is the contract between the company promising to issue you a share that has these terms in exchange for with the subscriber. So subscriber is the language that we give to an investor who is subscribing to for shares. It will stipulate how many shares, how much money for how many shares. It will incorporate what's going to happen if there is a default and how this share, what will happen on the subscription agreement if there is a default. So if there's a failure of the due diligence, or if they fail to get the approvals or to do the things that need to be done, this constitution or whatever it is. Often at this stage, constitution will be very much a pro forma document. A shareholders agreement will sometimes be as much as 30 to 60 pages long, depending on how detailed it is and what kind of terms, mechanics have been dealt with, particularly for redemption, for preemptive rights, for control provisions, etc. How prescriptive the budgeting and control process is. They're relatively standard, but it's kind of like saying that all Caucasian faces are standard. Like, they all have eyes, noses, mouths, but they're all completely unique to the individual / the deal as well. So you're going to start with a relatively standard thing, but you're going to pull it in. Now, I'm seeing them getting more and more standardized as we're getting more and more international investment. Because as our venture capital market gets more sophisticated, it's actually easier when we use the same terms. So AvCal also have a shareholders agreement. But it's really about, at that stage, what you take out. So you'll start with the standard, and then you'll work out, okay, these things are not going to be relevant to us. You very rarely end up with really bespoke approaches to preemptive rights or to put and call options or anything like that. But then again, the numbers clearly will be unique in each case. Does that help? The other thing that is pretty much universal is prior to closing, one of the things the lawyers will put together are all of the corporate resolutions, so the company resolutions that need to happen. So that might include the resolutions that you need to change that constitution. And so here I'm really just putting this, each deal is unique. There will be things that happen in each time. It may well be if you have some founders who started together and they've licensed some software from somebody else, you might need to get permission from the software licenser to get this new investor in. There might be some controls that you've built in here to make sure that customers are going to agree. So again, very rarely that there's much that's particularly special at this really early stage, but when we're getting down to where we're looking at really significant changes of control in the business or the potential for changes of staff, these could be quite substantive. They could include landlords' consents to change of ownership of the company in some way so that you can continue to rent your premises. It could include getting updated liquor licenses in relation to your bespoke gin business and your cellar door. It really depends on the industry and the nature of the deal.